When people trade in the forex market, they use the terms risk on and risk off to describe their feelings about the economy and how those feelings affect their willingness to take risks. Today, I'm going to help you make sense of what those terms are and how you can use them to understand what is happening in the market and also generate trading ideas. Let's dive right in. When traders feel optimistic and confident, it is known as risk-on sentiment. During these times, traders are more open to taking risks and are willing to invest in riskier currencies such as the Australian dollar or the New Zealand dollar. This optimism is usually driven by positive economic news, stable political situations, or rising stock markets. It is like a sunny day, and traders are eager to explore and seek higher profits in exchange for higher risk. On the other hand, risk-off sentiment occurs when traders are worried and pessimistic. This could be due to geopolitical tension, negative economic data, or a financial crisis. During these times, traders prefer to avoid risks and seek safety by investing in assets like gold or the yen. It's like when there's a storm and people seek shelter instead of venturing out into the open. Understanding these sentiments is essential in forex trading because they can have a significant impact on a currency's value. For example, during risk-on moments, the demand for riskier currencies could increase, leading to an increase in their value. Conversely, during risk-off periods, the value of riskier currencies could decrease as demand for them drops. Let's take a closer look at a real-world event, the emergence of the COVID-19 pandemic in early 2020. This global concern sparked widespread uncertainty and fear, leading to borders closing, travel restrictions, and a significant slowdown in economic activity. Traders all over the world were anxious about the potential economic impact, resulting in a shift to a more cautious and apprehensive sentiment. As a consequence, investors began moving their funds away from riskier investments such as stocks and certain currencies like the Australian dollar, the New Zealand dollar, and emerging market currencies that were considered to be more risky. Instead, they sought out safer assets. As a forex trader, it is important to maintain an inquisitive mindset and keep an eye on economic indicators, news, and overall market sentiment. This is crucial to anticipating and understanding these fluctuations. In my opinion, the best way to read market sentiment is to analyze and compare the very instruments they affect. It's helpful to think of global markets as a network of interconnected vessels. What happens in one part often affects the rest. Alright, so right here I want to give you the ideas that I use to find out whether we're in a risk on mood or we are in a risk off mood. Okay, so I have three ideas that I use. Number one is the credit default risk tolerance. Number two is the investment choice of the speculators. And number three is volatility. Okay, so number one, credit default risk. Oh, sorry, this is risk. It's supposed to be risk. Okay, so credit default risk. What that means is that there are certain debt instruments that comes with high default risk. Okay, while there are others that comes with very low default risk. So government bond, for instance, is a credit instrument. It's a debt instrument rather that comes with very low credit default risk. That means it is very the chances is very remote that the government, okay, will default, okay, on the debt. But there are other bonds, okay, other debt instruments like corporate bonds that are considered higher risk of they have credit, the default risk is higher compared to the government bonds because what the government can do, all right, like printing more money and all of that stuff, the corporate guys can do it. Okay, they have limited funds, and anytime they can declare bankruptcy and all of that stuff. Okay, so credit default risk is one way that we can find out, okay, which way the market is going. Are we in a risk on or a risk off mode? Because a bond that comes with a high credit default risk also presents higher yield as an incentive to investors, okay, so that they can come in and invest in that. So the reason why they should choose that bond, for instance, is not because of the safety, but because of the yield it offers. So why should they take the risk? Because of the higher yield. But government bonds that are considered to be they're considered to be safer. They comes with they offer a lower yield compared to the corporate bonds that has higher credit default risk. Okay, so when we monitor the risk tolerance here, the default risk tolerance, we can tell what the market is doing. Okay, so for instance, we plot the government bond like this. This is a US 10, considered to be one of the safest instruments in the world. This is a 10-year government bond of the United States, backed by the integrity of the US. And then we also have junk bond. These are bonds that are considered to be of very high risk, okay, or very low credit rating in the market, and the risk of default is very, very high. Okay, so we are comparing the performance of the government bond, which is safer, against a bond which is considered to be very, very high risk. Okay, so whenever the government bond is outperforming this other bond, which is called a junk bond, whenever the government bond is outperforming the junk bond, we say that the market is investing in safer assets. Okay, so we can say then that the market is in a risk-off mode. But whenever the market is investing in junk bond more than they are investing in government bond, all right, that means the market is in the risk-on mode. So they are not looking at the risk, they're all going for the yield. Get the point now? So this is why credit default risk tolerance is a very, very useful tool in finding the sentiment of the market. So here, for instance, when the market was going up, this was showing us that the government bond is outperforming the junk bond, and that means that the market is in a risk off mode. Okay, and here when the market started going down, we can say that the market is in a risk on mode, because as it's going down, it's indicating to us that the junk bond is outperforming the government bond. So number two idea that we can use to find out the risk appetite of the market. Now it's a good thing to have all of them, lining up and giving you the same signal, because that even is more stronger signal, right? So investment choice is a second one, and here we're looking at the choice that the speculators are making, basically. So in a risk on mode, it is shown that they will go for safer, for higher risk assets at the expense of safer assets, and then in a risk off mode, they will go for safer assets at the expense of riskier assets. And so we're going to be looking here at two markets that compete essentially for the funds of investors. Okay, so we're looking at the bond market, the government bond, okay, government bond versus the equities market, US 500. So we're looking at the 500 largest cap companies in the United States. So this is essentially investment in companies, okay.
Such investments are considered of higher risk compared to investment in bonds. Okay, so these two markets here are separate, they are different from each other, and they compete for investments of the big speculators. So one is safe, one is risky. So whenever the safer one is outperforming the riskier one, right, we say that the market is again investing in safer assets. Whenever the riskier one is outperforming the safer one, we say the market is investing in riskier assets, and then we are in a risk on mood. So when the government bond is outperforming the equities market like it did here, all right, so at the same time we saw that the credit default risk tolerance was very low, so the market was also investing in government bond as against the junk bond. We saw also here that the government bond, the US 10, was outperforming the equities market. Okay, so that means that investors were going for safety. And then here as well, we saw that that same thing happened, but here the reverse happened. Investors were actually going for equities, and up here we saw that investors were going for junk bond against the government bond. So here we can see the market was in a risk on mood. Okay, so that's the second one that we use. And then number two is the volatility levels of the market. We want to monitor the volatility levels of level of the market. So volatility means that we're looking at the rate at which price is changing. If price is changing too fast, okay, that poses high risk of investment or for investors, because when you have those fast changes, it is because there is some uncertainty in the market. The market's emotion is very, very high. It's a very dangerous environment to actually put in money. And so it's considered that when volatility is high, okay, when volatility is high or rising volatility and high volatility is not good, okay, for risk on investments. So during rising volatility and high volatility, okay, you would have safer assets doing better than riskier assets. Just as we saw here, we saw that volatility also rose here. Okay, so but on the other hand, if we have falling volatility also we see that that is good for risk on assets. Okay, so right here we see that this rose, volatility picked up here at the same time that investors started buying more into the government bond more than they were buying into the US 500. Or we can say essentially here that they were favoring the US bond, government bond, more than the US 500. Okay, and here we also saw that they were buying more into the government bond more than the junk bonds. So all of this was pointing us towards the fact that investors were in a risk-off mood. Okay, and so we should be trading more in line with risk of assets, risk of currencies. So we should be buying currencies like Japanese yen, Swiss franc, the US dollar against other currencies like the Canadian dollar, Australian dollar, New Zealand dollar, the emerging currencies. So those ones, we should be selling those ones and buying of the safer currencies. Then you also talk about the euro, because the euro acts as the anti-dollar. Whenever the dollar is going up, the euro will go down. Okay, so you can see that these emotions, as these emotions go up and down, the swings actually gives us the opportunity to make money. And we'll be giving you examples, okay, where we see how all of these did take place. Now you can get creative with these. Now the simple thing that you do is to just finding out which asset is considered to be a risky asset, which asset is considered to be a risk of or a safer asset. All right, so when you plot those two together and look at their performance, you compare their performance, you will be able to find out what is the risk appetite of the market. Because again, investors actually buy and sell. When they feel something, they buy. Okay, they express their feelings by actually investing, all right, in the market. So when they feel, for instance, that that fear is too much, that the risk of losing money is too much, what they do is you will see that play out in the market, because they will begin to buy safer assets. And when they feel that they can get yield, there's certainty in the market, they can go for those yields, then what they do simply is that they will begin to buy the riskier assets, which comes with higher yield. And so once you place a risky asset and a safer asset side by side and look at the performance, you would be able to tell what market we are in. But using these three ideas that I've proposed is very good, and you can use them together as they are, which I would say is the best. All right, so let's look at an example here. Let's look at how the Australian yen performed when we were in a risk-on environment and a risk-off environment. Now, like I told you guys, you can get creative. Okay, there's no limitation as to what you can do here. You have many charts, thousands of charts that you can use as your risk-on instrument or risk-off instruments that you can use, and you compare those two charts and you look up the movement of price as your indicator for the risk-on or the risk-off mood. So for me here, I'm using the US Treasury bond price. So this is essentially 7 to 10-year bond price together, and I'm comparing that against the Russell 2000. So US Treasury bond price versus Russell 2000. Russell 2000 is a small cap index. 2000 small cap companies in the US is what makes up this index. Okay, so I'm comparing the US Treasury bond price, that's the 7 to 10-year bond price of the US government, which is considered safe, against the small cap index, which is considered to be high risk. Okay, and so the idea here is that whenever the US Treasury bond price, which is considered safe, okay, so when safer asset is outperforming riskier assets, we are in a we're in an environment where the investors are going to be looking for safety. When the riskier asset outperforms or begins to outperform the safer assets, we are in an environment again when the traders are looking for yield, and they don't care about the risk. Okay, so they are going for the more riskier asset, pursuing the yields. So that's the idea behind the chart right here. Okay, so right here we saw that the market began to drop. Okay, this drop here was telling us that the US Treasury bond prices was moving down. Okay, was depreciating compared to the Russell 2000. That means the Russell 2000 was outperforming the government bond of the United States. Okay, and that is a risk-on environment. Okay, so we can see that right here, the market broke this low and then began to drop. So you can see that all of this was already showing us that we should go for the risk-on currencies. And so when you look down here, the Aussie yen right here, the Australian dollar is considered to be a currency that will perform very well during a risk-on environment, while the yen is considered to be an instrument or currency that will not perform well during a risk-on environment, but will perform better than the Australian dollar during a risk-off environment. But here we are in a risk-on environment, so Aussie, the Australian dollar should perform better than the yen. So we expect to see an uptrend on this chart. So right here we can see that we had this failure of the Australian dollar yen chart to make a lower low right here. So we actually made a higher low, okay, and then we saw the market begin to go up. Now above here we saw a breakdown. Okay, we saw failure to make higher highs, right? And then market begins to create that lower highs, and before breaking down and start creating lower lows, which is a bearish trend pattern. And so that was already presenting you good opportunities to trade. So you can see right here, look at this. when the market broke down here, this was a clear signal for you to go long the Australian dollar versus the yen, or to go long any other risk on currency like the Canadian dollar, New Zealand dollar, British pound, against currencies like the yen, the Swiss franc, and probably the dollar. Okay, and so we saw that even though you didn't catch the lowest low right there, you'd have caught it anywhere in the middle. All right, and that would have also been a very great investment opportunity. All right, and so you saw the market increase. This is daily charts that we're looking at, and I will advise you to always look at charts like this on the daily time frame, because it offers you better view on what price is doing. You can do it on the intraday time frame if your account with TradingView can allow you to do that, but I guess that these kinds of comparison charts, this kind of spread charts, can only be viewed on the daily time frame and weekly time frame, and also the monthly time frame. But intraday charts will not be permitted to do that if you have a free account with them. Okay, and so right here we saw the market going up here. That means that safer asset was outperforming the riskier asset. So US Treasury bond was outperforming the Russell 2000, and we also saw that the Australian dollar began to lose value against the yen right there. Okay, but here I want you to focus on this one. The market did rise, created a higher high, higher than this high, right? But the next high was lower high. Okay, and then the market broke down. We broke down here. Okay, when we did broke down after failing to create a higher high, that was a bearish signal. So essentially the market made a double top and then broke down, right? So it is showing us that the market is also in a risk on mood, because the US Treasury, the US government bonds was underperforming the Russell 2000. Russell 2000 was doing better. All right, so which means the riskier asset was outperforming the safer asset. And here we got that confirmation, right? We got that confirmation, and we saw that the Australian dollar was starting to outperform the yen. Okay, so we can see here that the Australian dollar began to break up above this trend line. Okay, let's say for instance you were still scared because the market here has not yet given you that signal. But right here, okay, when the market did break up this high and break past that level, okay, that was a very clear signal, guys. And then you see that the Australian dollar continued appreciating against the yen, all right, and went on giving you hundreds and hundreds of pips. Okay, so those are very good times, good signals that you could have used to profit. And you also have the option of choosing from the Canadian dollar or the New Zealand dollar against the Japanese yen or the Swiss franc as well. All right, so let's go forward, guys. Now this is another example, and here I'm looking at the GBP USD and the Australian USD, and we're going to monitor how they performed during the risk on mode and also the risk off mode. And with this one, I'll be using this opportunity to show you something, how you can choose between the risk on currencies and the risk off currencies, which one you should be trading, okay, based on their strength and their weakness, because that's very important. You're not going to be trading all of them, but during a risk on mode, for instance, you want to be trading the strongest currencies within that group of currencies that does well during a risk on mode. And when we're in a risk off mode, you want to trade the weakest, okay, of the currencies that does well during a risk on mode. Okay, so let's go in here and I'll show you exactly what I'm talking about. So again, this is the US Treasury bond price versus the Russell 2000 again, and that same chart right there, but only this one below has changed. Okay, so the yellow line is the Australian dollar USD, while the white line is the GBP USD. Okay, so I want to show you something. All right, so Right here again, when the market started coming down, it was showing us that we are in a risk on mood as the Russell 2000 began outperforming the US Treasury bond price. Okay, so this was a good time for us to buy the riskier currencies against the safer currencies. Now, look what I'm talking about here. The Australian dollar is considered to be a risk on currency. The British pound also is considered to be a risk on currency and should do well, or should do better than the US dollar during this environment. Okay, now I want you to look at something. Right here, we saw that this low, right, was lower than this one. In other words, the Australian dollar USD was actually making higher low compared to a situation where the GBP USD was making lower low. Okay, so we are actually in a risk on move here, or risk on mood. Australian dollar making a higher low versus GBP USD making a lower low. This is showing us that the Australian dollar is stronger than the British pound at this particular time. And if you want to trade this risk on mood, you want to trade in this risk on phase, so you're looking for the best risk on currency to go for, that would be the Australian dollar. Okay, so you should be trading the Australian dollar against any of those currencies which does not do well in the risk on phase, which is the Australian dollar, the Japanese yen, the Swiss franc, or the dollar. So in this case, we're looking at the dollar. Okay, so it would have been a very, very, very great idea for you to buy the Australian dollar against the yen at this particular point in time. All right, and again, here we saw that the US Treasury bond price began to perform better than the Russell 2000, showing us that we are in a risk off phase, and so we expect the Australian dollar to perform badly, okay, against the US dollar, and the GBP also to lose value against the US dollar. So what currency should we buy in this case? What currencies should we buy? All right, and you can take, for instance, here you can see that same idea also playing out again. So we are looking at the divergence between the British pound and the Australian dollar. So look at what was happening here. While the Australian dollar continued making that higher high, right, the GBP USD went on to make a lower high and started looking to come down. Okay, so which one should I sell? Which one should I sell? The Australian dollar was still showing that strength that we saw below here. So the best thing for us to go short on was the GBP USD. Okay, the GBP USD would have been the best currency to go short on because it was showing this weakness against the Australian dollar. So during this environment where the USD is suspected to be stronger than both, the best one to pair against the dollar, okay, should be the GBP. So we should be selling the weaker one now between the two of them against the US dollar, which is expected to be stronger during this risk-off environment. So this was a risk-off environment, as we saw this up push here. So the US Treasury bond prices was rising against the Russell 2000. So right here, what do we have? We have the, again, here we're making this, there's a failure to make a higher high, and market made the double top essentially and then moved back down, and trend line, uptrend line here was broken through with a very, very big candle. Now all of that was showing us that we are now in a risk on mood, okay, and that is most likely going to continue. We don't know whether it's going to continue at this point when this candle did break below, but we just want to believe it should continue, and then all we have to do is to look for that bullish setup on Australian dollar USD and GBP USD. But looking now and trying to find out which one should I go for. Should I be buying the Australian dollar USD, or should I instead opt for the GBP USD? Okay, I've shown you right here, back here, that there's a way that you can find out the best one to go. So again, here you see that this low, okay, which lines up with this high, and this low lines up with this high. Same for the GBP USD. This low lines up with this high, and this low lines up with this high. Now watch what happens here. Similar to what we showed before, you can see that the market here made a higher high, but here the GBP USD was making that lower low. Okay, here the market was making a lower a higher low, while the GBP USD was making a lower low. So this is showing us that British pound was weaker than the Australian dollar right now. So right now that we are in a risk on mood, we should be buying the Australian dollar against the US dollar that is expected to do weaker, or to perform weaker or perform badly against the risk on currencies. And so as we can see here, we saw that the US dollar went on to lose value a lot against the Australian dollar. But look at what happened. Okay, so you see the usefulness of this right now. Look at what happened with the GBP USD. So GBP was expected to perform better than the US dollar, but look at this. It just rose up initially and then went sideways right there. Okay, so this is how you can make your pick from it doesn't matter what it is. This if we're in a risk on environment and we are looking for two currencies, we are looking at two risk off currencies that we should go long on against any of the risk on currencies. What you can do as well is similar to this. All right, so let's look at the last example. So I'm picking the Canadian dollar CHF, okay, the Canadian dollar Swiss franc. Now, same chart right here. I told you can use anything, but here I'm still using the US Treasury bond price versus the Russell 2000 because it fits very well. You know what we need. All right, so it's giving us the very you know, the exact thing we need. Okay, so right here, when the market started going up right there, it was a sign that safer assets was outperforming the riskier assets. Okay, and that same thing was seen here when the Canadian dollar began to lose value against the Swiss franc. Like I told you, Swiss franc is considered to be safer, and during this risk-off environment, investors will be buying into the Swiss franc compared to a currency like the Canadian dollar, for instance. All right, and here, when the market rose up to this point, we started making lower highs and then started creating lower lows. So bearish trend pattern. And when you look below here, we saw that the Canadian dollar CHF chart was making these really nice inverse head and shoulders pattern, which is a bullish reversal pattern. We expected bullish prices here. So we have this left shoulder, we have the head, and then we have the right shoulder right there, and we expect the price to continue up. So this was bullish pattern, while this was a bearish pattern right there. All right, so now we're expecting to see this risk on continuing, and we are also expecting to see Canadian dollar here. Because of this, we're expecting to see Canadian dollar improve or increase in value compared to the Swiss franc, and that's exactly what happened here. We can see that the Swiss franc went on to lose value against the Canadian dollar, as the Canadian dollar did rise very strongly up with these former highs. And then here we saw again the opposite scenario playing out. We entered the risk on phase where we saw the market gapping up here and begin to push higher, right? The push higher, this was a risk off environment, and we expect the Swiss franc to do better than this Canadian dollar, and that's exactly what happened here. See that push down, market did go down. All right, and again you can see same thing happen here, and then finally here when we were in a risk on environment. Okay, look at exactly what happened here. Look at that, what a beauty. Okay, look at the push higher. So this is daily chart, guys, and you could have used your intraday chart to find our the setup that lines up with your expectations. So looking at what is happening with emotion and understanding where money should be flowing into, you go into your daily chart, I mean your intraday chart, okay, and then you look for the setups that you want.